Good morning, everybody. Welcome to the Flow Show. Here we are, nearly at the end of the week. Oh, another long one. It's been a bit of a slow one, but a long one nonetheless. Hope you've all had a good week so far. Hope you don't go spoiling any good trades and good profits on the last day of the week. So, yeah, take care for the rest of the day. Right, let's get into some bits and bobs. I do have Gregor joining us as well, so I'll be keeping an eye when he pops in so I can get him promoted. But let's go through some of the news headlines thus far. China's Ministry of Commerce has apparently held a meeting on national export control work, whatever that means. A lot of ministries are getting busy right now. We know we've got this Ministry of Finance briefing announcement coming tomorrow, which the market is expecting a load more stimulus measures, fiscal stimulus measures from them. There is also a meeting of various other ministries on Monday as well. It's probably just a knock-on from the MOF meeting, but again, that will be eyed by the market and investors too. We have just had a headline out from Bloomberg citing a Chinese notice. I'll tell you what it is: the notice of the General Office of the State Council, giving some opinions on the China's Securities and Regulatory Commission and other departments on strengthening supervision, preventing risks and promoting high quality development of the futures market. This message contains an item that they are studying opening up stocks, index and bonds to foreign investors. So that market might be looking at that as well. But anyway, lots of news to come out of China. Overall, you've got to look at this China stuff in simple terms and what it means in real terms. In simple terms, any big fiscal easing announcement this weekend will likely see risk stocks, risk assets rallying. So look at your usual suspects, commodities, commodity FX, stocks and the like, if it's big news. But that big news might be tempered once again because we still need to see the results of such big actions. If the market doesn't get any big news this weekend, then we're going to see those risk assets showing a bit of disappointment. It's also important to know, okay, all this is directed at the domestic economy, okay? The fact that international markets are taking notice is one thing, but they are not dropping these measures for international growth. They're dropping it purely for domestic growth, and the market is tying a line that if China grows, the global growth grows, which may have been the old story, but this new story is slightly different because we know there is a ton of trade tensions between China and the rest. So just because China's economy starts growing doesn't mean it's going to be a boon for the rest of the world. It's not going to wipe out all these EV tariffs being lumped on by the US and Europe. It's not going to fix chip issues with the West limiting what China can use due to security concerns and that. All those geopolitical issues are not going to change on this announcement, okay? So that's just something to keep at the back of your mind. This is all for China's domestic economy, okay? Whether foreign investors see it as a good reason to get back into Chinese stocks, wholesale is another thing altogether. ETFs is one thing, direct Chinese investment is another. Anyway, that's China for you. So that is a weekend risk thing to keep an eye on, one of them this weekend. Over at the good old cheese eaters at the SMB, we've had SMB's Martin saying most of Swiss inflation today is domestically driven and service related. Swiss inflation is expected to remain firmly within the 0 to 2% price stability band. There could be further rate cuts in the future, but there's currently no plans to use negative interest rates. Oh, let me just give Gregor a promotion. Now I've seen him in the room. There we go. Over in The UK, we've had a bit of data out, GDP data, monthly GDP data, industrial production and whatnot. Overall, industrial production and manufacturing production posting half decent numbers and a good bounce from negative numbers last month. IP up 0.5% from minus 0.7%. Manufacturing up 1.1% from minus 1.2% previously. GDP, nothing to write home about. It came in at a whopping 0.2% on the month versus flat prior. The 3-month rolling change, 0.3%. Think of this as a rolling quarterly number, 0.2% versus 0.3% expected. So the government might take a little bit of a bow that they saw some positive growth in the second month of their governorship, but we're still dragging along the floor here with these 0.1s, 0.2s, 0.3s. So they certainly can't do any victory laps on that. Germany, final CPI numbers unchanged over the flash numbers, confirming the drop from the last month. So moving on. ECB minutes were out. Again, these minute releases that we get from central banks aren't really much market moving news now, as we hear so much from the members in between. But they said inflation it's still expected to rise again in the latter part of this year. Well, we've only got 3 months left. Then it was expected to decline towards target over the second half of the year. So that's, while we know this news, it still suggests that the ECB aren't going to be in a rush with rate hikes, even though we're due one potentially next week. But they still think inflation is going to bounce, and they'll be wary about that. They did say the risk of undershooting 2% is becoming non-negligible. Well, if that's not a line that's going to bite them in the arse down the line, I don't know what is. Moving over to the USA and back to their data yesterday, and a bit of a funny day, this one. CPI coming in hotter than expected. The core going up to 3.3%. Headline CPI coming in hotter than expected. Still a drop on last month, but not as much, only a pip down. Some of the other monthly measures coming in hotter as well. And all the bits and pieces the economists like to get stuck into. Super core, that came down to 4.321 versus 4.453, so positive there. But shelter, inflation, and within that the owner equivalent rents thing that everyone keeps looking at, that came down from last month, but was still positive numbers, 0.2% for shelter, 0.3% for owner equivalent rents. Wages, though, went up. Real average earnings went up to 1.5% from 1.3% year on year. Real average weekly earnings year on year was unchanged, but came in at 0.9%, so still looking hot there. So overall, hot numbers. You would have thought the dollar would have rallied on that, and it tried to for a second, until the market saw the jobless claims number and decided to, technical terms, shit the bed over that. A 28k miss in jobless claims, or 27k if you take that expectation. And the market absolutely spanked the dollar. Yields dropped some 10 BPs in 10 years. Continued claims going up to 1.861. The end of the world must be nigh, you would think, on the back of that market reaction. Well, not really. We've been talking about this for a long enough time. Look at that, flatlining around that 200 to 270, 280 mark. Anything in there, boys and girls, that tells you that the market should be panicking about this index, and whether we're seeing, a big, huge trending up in jobless claims? Absolutely not. I had a go at fading the move yesterday because I thought that was a complete bullshit move, with limited success in dollar yen. Probably should have picked another horse, but I fancied doing some rodeo riding on that one. Then, as usual, the market got round to the explanations, and obviously weather came up front and centre, that the prior hurricane has impacted certain areas, particularly those areas affected by Hurricane Helene, North Carolina and the likes, who saw the largest increases in claims. So that pushed that number up there. What it has done, though, it's shown how sensitive the market is to jobs data, and particularly those jobless claims. Any slight wobble, and we've got a bit of an indication now that the market wants to move quite bigly on those sorts of numbers. So keep an eye on that moving forward. Obviously, things like this are going to get a bit more messy with obviously Hurricane Milton blowing through. So maybe we should expect the same, similar over the next couple of weeks in this jobs data. But the market may not react too much if it knows it's weather related. But as I've been fond of saying, until we see jobless claims trending above 400,000 a week, continued claims 2.5 million, wake me up when that happens. Fed heads were out and about talking about inflation. Fed's Goolsbee says inflation came in around expectation and there was improvement on the housing front. He's also in total agreement with the spirit of Fed's Powell and his comments. Says there will probably be more close Fed meetings, and says so far it's been a series of close call type meetings. Seems that not everyone is on board with how they're going with rates, as we saw from the minutes last week or this week. Many of the Fed heads wanted to go 25 or preferred a 25. They didn't vote that way though, but they preferred it. So maybe they were going to see maybe a few more dissenters popping up. But as we're likely to go 25 at the next meeting, that should keep probably plenty of them happy. Fed's Barkin says inflation has come down significantly but cannot declare victory. Sees a risk, lower rates could boost housing demand. Talking a little bit backwards, he said an earlier start to hikes could have lessened the need for rapid hikes. Fed's Williams expects that the economy will allow the Fed to cut rates further. The pace and size of future cuts will be determined by the economic data. It's important to see government debt to GDP ratio fall at some point. When he said that line, the audience burst out laughing. Fed's Bostic, little bit of a hawkish slant. Speaking to the Wall Street Journal overnight, he said he's totally comfortable with skipping a meeting if the data suggests that's appropriate. So pendulum doing a little swing there between cutting 25 and unchanged. We've still got this Israel stuff bubbling over. It's a constant headline flood at the moment. The current state of play is that Israel still hasn't really announced what they're going to do as far as their big retaliation that they've touted. US has been scrabbling around to get them to make it clear what they're going to do. Doesn't seem that the Israeli cabinet is clear either, because they failed to vote or agree on a decision last night at their meeting. Other Gulf states are putting the pressure on the US to stop Israel attacking Iran's oil fields. That's according to sources in the Gulf. So we're still at this position where we don't know what's coming, we don't know when it's coming, and we don't know how much damage it's going to do and what it's going to hit. If we don't have any clarity on that going into the weekend, again, it will present more weekend risk you need to be aware of. Coming over to the UK, and UK Chancellor, apparently one of her plans is to raise capital gains tax as high as 39%. This is a cue for investors, foreigners, to take money out of the UK again. Current capital gains tax, it's all different bands, and depending on your income and what your assets are, or what assets you're in and making money from, range from anywhere between 20 and 28%. So up to 39% would be a big jump. That's a touted measure. So this is the sort of thing that will get investors running to the door, the exit door, and something that could weigh on the pound as well. Trump is also throwing a few more policies into the mix that he's potentially going to do if he takes over. Apparently he's going to make or propose making interest on car loans fully tax deductible. He also said that if elected, he will formally notify Mexico and Canada of the plan to invoke the 6-year renegotiation provision of the USMCA. And his reasons for that is to address concerns on Chinese auto productions. So we know he's threatening to put tariffs on any vehicles and stuff coming in from Mexico. Started off at 100% tariff for cars, and it jumped to 200%, might go to 300%, who knows. Also, Canada might be in the same boat with that, but all are worried about the China influence. So maybe some agreement there, some cooperation there might mean he eases up on those tariffs of stuff coming into the US from those countries, but that's something that remains to be seen. But once again, it shows you that these countries, Mexico, Canada, are worried about Chinese auto production, and that's something that, again, whatever they do on Saturday is not going to affect that line of thought. Right, that's it as far as I got on the headline front. Not much else I can see that's of any real importance. So we'll have a quick look. I'm going to bring Gregor in to have a look at things. Morning, mate. How's it going?
Hey, man.
Hello.
Hey. Was muted. How are you? I'm fine, thanks.
Good, mate. Good. Right, what are you going to be looking at today? I know you're going to be looking at a few pairs, gold as well. So do you want me to hand you over the screen?
Yep.
Second. There you go. All yours, mate. How are you? I want to ask a quick question. How are you seeing things going into this weekend with all these risk events happening?
Well, I just think that maybe it's going to be some pause for the US dollar, at least from what I have seen so far. I mean, we had even this CPI miss yesterday. I mean, it was 2.4%, but still maybe this will slow down maybe a dollar in the short term, because it was not maybe a dramatic move for the market still. It was not around 2.5, which would be a very big, massive mover. And also it was not below 2.3. So I think that maybe now it will be a more sticky for the US dollar, but maybe some correction in the near term here. Just a second. Can you see the screen?
Yeah. Thanks, mate.
Yeah. So maybe I will bring on this chart first to give the full perspective of, and maybe give some idea how the Elliott wave works actually in waves. So we have here 5 waves down and then a 3-wave rally, right? And this rally, even if it's corrective, well, it still produced some very nice gains. And if we will compare this kind of a structure with dollar here, you can see that we have only one leg to the upside. So because the move is actually very, very strong, I just still think that there is plenty of room for more upside. And I'm still looking for this 104 level. But as I said, maybe in the short term, because of this move, which was quite strong, and we were not seeing continuation higher, much of the continuation higher yesterday, I just think that maybe it's time for some pause here. So if we see a drop here on the dollar, I just think that this will bring a lot of pairs to maybe even interesting levels for potential shorts. I like Aussie, Euro, Cable, all of them are looking very bearish, and I think that if we get some kind of a recovery, that will be just better levels for potential shorts. So I'm definitely in the short term, I'm bullish dollar and will be expecting for more upside, especially as I said, if we see this kind of a pullback. Now, I really like gold. Okay, so gold, no matter what dollar has done, I mean, gold is doing relatively well. We have seen obviously some pause here maybe due to this recovery on the dollar. But now again, after this drop and a pullback into this very nice area here around 2,600, which basically was this level from mid of September when Fed made a 50 basis point cut, and now this is the same level as a potential support. You also have this channel as well, and the 38.2%. And so far we have seen a very nice bounce, and I think that there is actually a chance that we will break higher. And obviously this would make much more attractive here for metals if we really are going to see some pullbacks here in the near term for the dollar. So as I said, gold is stable even when dollar is up. And now if dollar will see some retracement, I just think that gold could immediately break this channel and possibly move close to new all-time highs here. So that's for gold, and we also shared pattern in play as well for FA members, and I will definitely keep a very close eye on this one and will update it as the price action unfolds. Regarding Euro, since I mentioned it, I think that these levels that can be very attractive on the downside could be around 1.10 to 1.1040, which could cap the upside here for this wave B. So now we are coming close to this support level around 109, 108. So we have possibly very late stages of this first impulse down. So some relief rally can certainly be expected here. Also very big levels for cable, clearly here around 1.3, maybe another push to the downside to clear maybe some stops here below that level, that spike from September 11th. So maybe we see a little bit of more weakness in the short term, but definitely what I would keep an eye on is on a free wave rise. So really we'll have to be patient here and just wait on the levels to be retested on the upside before maybe trying to identify some shorts here on those pairs. Also, I would take a look on Aussie. Aussie, as you know, in commodity currencies in general, has been very weak, and basically Aussie been looking for a top here ahead of Hang Seng Index. So here at the bottom we have Hang Seng Index, and as you know, after some impressive rally over the last few weeks, we are now even seeing a pullback on Chinese markets. So I think that this pullback still is incomplete. As I showed you here, even if there are just the poses, you can expect that these poses will be made by free waves. So either that's an uptrend or downtrend. And now if you look closely here, that's only one first sharp to the downside. So there are a lot of traders who want to maybe catch some to join the uptrend here. Then you get the wave B rally. They will pull their stops very tight and higher, and then wave C occurs, it will kick them out, and that's basically when the uptrend can resume. So from a psychological perspective, this ABC correction totally makes sense. And I would be expecting this wave C to unfold maybe next week, and obviously this could send Aussie even lower here. But maybe it's not Aussie versus US dollar the only one that I would be tracking. I also like Aussie yen. Now Aussie yen has came back to this very nice resistance at 61.8%. Also again, with the clear free waves to the upside. Of course, we have to see some aggressive sell-off on global markets, not only a turnaround on China, but you also have to see US stocks coming to the downside for Aussie yen to suffer or turn higher, Japanese yen as a safe haven. But overall, when looking also at the dollar yen, sorry, I'm running out of voice today, not sure why.
It's Friday, mate. It's Friday.
Yeah. So dollar yen, definitely also at very interesting levels. I know that we have been covering this one a lot in all of webinars, and we certainly are coming to these levels that should be respected. Not easy to be bullish here, in my opinion. I just think there is a plenty of risk that this market could actually turn the opposite and to resume the downtrend soon. And whenever that could be the case, maybe Japanese yen will strengthen across the board. But the only question is, what will be the key driver for this dollar yen maybe to turn around? If the US yields will keep pushing higher, then of course dollar yen could be more sticky around these levels, but then that's when maybe yen crosses could be much more attractive. That's why I will keep an eye on ASEAN, because I know that if US yields will keep pushing higher, this one could keep dollar yen closer to the resistance rather than support. So that's basically it. If anyone has any questions.
You go get yourself a beer, mate, I think. Clear that old frog. But yeah, if you've got any questions for Gregor, then please do put it in the chat. I'm sure Gregor will stay around for a bit longer. I'll just grab it back quickly, mate, unless you've got anything else.
No, that's it.
Right, I'll just grab the screen back quickly, because it's interesting, you know, there's all different technical analysis and different people do different things. But what I find at the moment, particularly with a lot of Gregor's analysis, is that it's matching up with mine. So I may look at different things, but I still have the same sort of pictures. I'm going to go into Aussie dollar here. I've got a load of support. Let me share my screen first. That might help. There we go. I've got a load of support in Aussie dollar around this area here, the 67s I've been pointing out. Got that fib 67.15, got the 55 DMA, the 100 DMA, all coming in around a level 67 that's a level all on its own. Now, Gregor was saying that he doesn't look like, it doesn't feel like we're done with the downside. And I agree, we're hitting all this support, but the bounces are pretty weak. If we can't get above 67, 40, 50, then we're not going up here. And if we're not going above there, we're heading down here somewhere. So I'm agreeing with Greg, and it's good that it doesn't matter what your tech slant is, whether you look at waves, whether you look at moving averages, RSI, all the rest of it. What does become important at times is when all the different aspects tend to line up for the same potential outcome. Okay, so I don't look at waves, not my cup of tea. I respect Gregor who does, but I have the same view as him. If we can't break up significantly, the likelihood is we're going to be heading lower. So I am in the same boat as him. Just to go over some of the others just quickly, again, it's similar pictures. The one thing with this one compared to some of the other dollar pairs is that we've had more stability this week. Okay, it's been a bit more sideways. We came down here last week and we've pretty much gone sideways. If you look at something like euro dollar, this week we've had the move down and it's continued to come down and we've continued to move lower. Now we have tapped the figure here in euro dollar at 109. We chewed through all this level, but here we are trying to get back above this sticky area again here. 109, 50, 60 is the level I was watching on the way down. Had plenty of action, couldn't get through it until we did get through it. So it's probably going to be the same story on the way up. We need to get through this area before even thinking about another test of 110. I don't see anything major coming from today's data. We got PPI and the flash Michigan number. So unless there's some huge variations in the details, I'm not expecting huge moves. What I think for euro dollar is we're probably setting up a bit of a range play 109, 110. So you've got all these levels in the middle. You can trade them if you offer them if you want, if you're a bit of a scalper, but maybe use them for a bit of a pivot area or pivot levels. If we're getting back above 109.60, we're probably on for a move up towards 110, and then you get to see what happens there. So directionally, the big direction is going to become if we're going back above 110 or if we're breaking under 109. Okay, because that's probably going to drive things, and then we see what else is there. I know Gregor's got a level 108.80, I think it was, mate, in euro dollar. You were putting in the chat room earlier.
Excuse me.
In the euro dollar, I think you had level 108.80 was one of your levels down below.
Yes, exactly. 108.80, 109. That's the support. That's the spike. I'm not sure what happened back then in August, in the middle of August. Yeah, right here.
Yeah, that one there. Yeah.
Must
Yeah,
have
I mean,
become news or something.
I'm 10 pips away difference. I've got a level 108.70, which happens to be the 61.8 fib, and it lines up with my level here, which, just to show you in a messy format, goes back absolute years. It's a big zone. Big zone. So this is an area, and it happens, on top of it, happens to match, as I said, the 61.8 fib of this move from June. So it's going to be a big level all on its own. But again, the techs seem to line up. Cable, again, similar picture to what Greg is saying. We've had a bounce near this 130, couldn't quite get down there. Now it's got to get through the traffic levels. But again, this secondary trend is keeping this move going, this bearish trend. So unless we start getting back above 131s, 131.10, there's every chance we're going to be heading lower. But this one, like Eurodollar, looks just a bit more weaker than the rest. Yeah, exactly, Gavin. Got to get over that 109.60, 50, 60 area. Can we analyse the Bund? Oh, Greg, you got anything on Bund? On your waves? I don't even think I've got.
Yeah.
Well,
Let me
have a look. I mean, I've not got any tech analysis on it myself. You got any stuff on the Bund? Do you want me to kick it back to you?
Yeah, I'm just opening the charts.
No problem. From a fundamental perspective, obviously, what's going on in Germany is a bit of a concern. A lot of people are talking about the spread between Germany and the UK in particular, but it's a bit of a false one because there's two different forces going on. But you got to think about what's going on in Germany, the problems they've got there. There's still a bit of a premium in the southern states, hence why Spain, Greece, Italy, even France are still got higher yields. But yeah, perhaps there's going to be some further easing measures coming from Germany over the future. Right, screen's yours to take, mate. There you go.
Okay, I'm just adjusting something here. So here on Bund, let me just make this. Okay, so I still assume that this recovery here from October 2003 is not finished yet. We are in a wave C and we are yet to hit these highs, but it really depends what the ECB will do, what are the expectations. They are obviously much more dovish compared to the Fed, and maybe this rate differential between Europe and US will keep, at least in the short term, will keep the euro dollar in downtrend. But basically here now, from an Elliott wave perspective, we could be possibly testing some key support here in a wave 4. But if we start dropping back to 61.8%, then I'm afraid that this range will transform into some kind of a triangle or something. So that's when maybe things could become a bit more tricky. But for now, as long as we are here around the 50 and 38.2%, there's still actually a chance that we will stabilize.
Thank you very much, mate. Good stuff. Right, I'm going to grab it back again.
Yeah,
give me 1 second. While we're talking about yields, going to have a little mooch at US yields, because I think particularly for the rest of today, we're going to need to keep an eye on these. We had that, obviously, that spike up yesterday, which quickly washed out. That was the inflation reading spike, which turned into the jobless claims drop, which we saw there. We're not looking like we want to go to those highs. So again, I agree with Gregor that maybe we're seeing the dollar maybe going to start easing a bit, or at least a bit of steam coming out of the dollar rally. But keep an eye on 2s, keep an eye on 10s. If we start breaking these levels today, then the dollar's going to follow again, and we're probably going to push the downsides in some of those pairs: Aussie, Kiwi, pound, euro, you name it. So yeah, keep an eye on yield today. If we don't manage to get above these highs, if we find just we pull up short in 10 years, the yield's there, same in 2s, we don't quite get back up here, then you could see, as I say, a bit of risk trading going on into the weekend, or risk asset reduction, risk position reduction going into the weekend with all those events going on. Dollar CAD is another interesting looking one at the moment. We knocked our head pretty much on this level here around 137, 60s, 70s. It's a bit of an on-off line. It's not a huge one, but it's one of those ones where all of a sudden you find yourself there and something's happening. So we're up there again. It's looking very bullish at the moment. A couple of key technical notes to keep an eye on. We've opened the day above this 137.35 level, which again is another just one of those levels we can mess around previously. So that's a particularly bullish move for today. Obviously, we're not that far above it, but we've got Canada jobs data today as well, so that could be a bit of a mover. If we see a bit of a data mover, maybe we pull back under it. If we quickly get back above it, then this is going to be a bit of a confirmation of this rally that's been obviously fairly strong over the last few days. And then we might get a bit of a push up, maybe go and have a look at some of these big levels up here in the 138s, maybe another mooch into the 139s, who knows. Down below, we've got a bit of supporting tech coming in against some of these big levels. So 136.50's got this 100 DMA joining it there. Below here, the old 136, 136.15 level in this zone, we've got the 55 DMA and the 200 DMA coming together. Now, as I explained in our chat room, the 55 DMA crossing under the 200 DMA is called a death cross. Okay, so expect to hear a bit of squawking about that going on. It's a bearish signal, but I don't really trust those sort of signals, because the reason that's going to happen is because of this here, this move from the 139s. This is factoring in all that. So it's a bit of a lagging move, but a lot of people take that as a bearish signal. Do you like the old golden crosses and death crosses, Gregor?
Yeah, I mean, I pay some attention to them, but not that frequently. I more use like 50 simple moving averages on the daily, and if the price is well above it, I define this as simple as an uptrend. Or if we are below it, it's a downtrend. So I'm more to like a more simple approach.
Yeah, exactly what I do as well. I use them more as, you know, this is a bit of extra tech around a level, or this is a bit of a confluence around a level. You know, the more tech indicators you've got coming in close together, you know, the greater the potential odds that you see a move off of that level. So it's also good areas to lean your risk against. So that's what I use them for.
Also, if you are waiting on this cross to occur, actually it can be a bit late, and move can be much more extended already since the cross happened. So
exactly. It looked like we're maybe a day or two from this cross happening, which if it's a bearish signal, it doesn't look very bearish on the price action when you've had, you know, 7, 8, 9 days of gains.
Exactly.
So yeah, that's why I don't trust it too much as a signal. Let's have a quick look at what's going on in oil as well. Just keep an eye on the clock. This one's likely to remain bid going into the weekend if we haven't had any clear news out of Israel and Iran. Again, gap risk is possible here if something happens over the weekend. Gap risk up, gap risk down. If the best outcome happens and maybe there's some de-escalation of hostilities, we probably see oil going right back in US oil going back down to the 70s. Brent, that'll be going down to probably the 72, 71s again down here. And then if it's good news and it's a de-escalation, we go back to trading the fundamentals, which are still pretty shitty, and no reason to be piling into gold. I'll have a quick look at gold as well, just because I'm mainly trading it, because I had a little nibble here when we got back above this level. We were mooching around in here, and then we got back above. Wasn't clear, what didn't really make a real strong decision until a bit later on, but we got above and we did get a hold above it now. it's put us right back in the middle of this range. So it's got to do a lot more. There's a bit of traffic through here, 50, 60. But now we're above here. Maybe we go and look at the top of the range up at 27.70s again. And if that holds, then we're back into range playing. Then we'll see what happens if we come down here again. But that one's got back in the box, as we like to say. This fib played like an absolute demon. 26.03.04. That's where we held support just ahead. Everyone was looking at the figure 2600. So it's probably a mixture of both big figure support and that fib in play there. So it's playing nicely with the techs at the moment. You know, if you're trading, you want these nice clean moves off the levels. You don't want any wishy-washy crap like you get here, and the level's not really defined. It's always love it when you get clear defined levels that you know, it makes trading much easier. You know how to limit your risk, and you know where to get your entries in. So yeah, love it when the tech's nice and clean. Doesn't happen everywhere, but when it does, you've got to take note of it. Simon, looking at the S&Ps. I know you're looking at wave pattern there. That says S&P back down to 55. Gregor, you see S&P back down at 55 at some point?
Yeah, at some point, definitely.
Definitely.
I
well, when
see
you know when, let us know.
we'll
go short.
I see a lot of potential, as I posted on Skype a few days back. I see a lot of potential wedge formations here. Maybe it's still not around the top, but definitely it's something that we will have to consider. I mean, even German DAX, if we get another push to a new high, could be possibly going into some wedge. And if I consider that dollar is already making some very impressive rise, I'm not sure how long stocks will be able to handle this.
Yeah, you're looking at something like a bit like that.
Yeah, something similar, yes.
Yeah.
So of course we are always in uptrend on stocks, but at these levels, also around the elections, I'm not really sure if they will allow stock market to come to the downside. They always said that even if the stock market will sell off ahead of the elections, during the elections, get ready for some nice bounce. So still, maybe after next dip, there will be more upside coming, but I just think that at the end of 2024, or maybe even in 2025, I just think that this could be a massive cycles going on.
Yeah, that's certainly possible. And it's an apt time to remind you that we do get the first of the Q3 earnings coming through today. A lot of the financials, JP Morgan and the banks and whatnot. So they will be closely watched. So if you are trading stocks, if you're trading off the techs, then be careful, because those earnings numbers is something that I don't give a monkeys about, our coloured lines on the chart. So take all your levels with a bit of a pinch of salt today when we start getting those earnings. Maybe just focus on the big ones, like down here, 56.50s, 56.70s. All these little intermediate lines, I wouldn't trust them too much if we're going to get some big earnings details, good or bad. Right, I think we shall call that a day for today. Thank you, Gregor, very much for joining us on the Flow Show and giving us all your wonderful waves. Thank you to all our viewers. Cheers, mate. Thank you to all our viewers for coming and watching us this week. I hope we've served you proud. We'll do it all again next week. So have a great weekend. Trade safe, and we'll see you next week.
Bye-bye.
Cheers, mate.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.